Hello and welcome to Noble's virtual conference. My name is Pat McCann. I'm an analyst here at Noble Capital Markets. Today I have the pleasure of introducing inTEST Corporation. We have the C-suite with us today, and before they get started with the presentation, I'm going to go ahead and just make sure everyone's aware that if you have any questions, you can drop them in the Q&A box at the bottom of your screen, and we will get to as many of those as we can at the end. So without further ado, I will hand the floor over.
Thanks, Pat. I'm Nick Grant, President and CEO of inTEST, and with me today is Duncan Gilmore, our Chief Financial Officer. And we really appreciate your interest in inTEST Corporation. The company is a technology company. It's been around for over 40 years, and but a lot has changed over the last four. Look forward to walking you through it. We do include some forward-looking statements in the materials today, and we will reference some non-GAAP financial measures. Information of these can be found in the deck and on our website. So, inTEST Corporation. I joined the company back in 2020. I was the first external CEO brought into the organization to really help unlock the company's potential. As I mentioned, it's a 40-year plus technology company, started in back-end semi, and really rode that back-end semi test wave of CapEx up and down for decades there, and really started driving diversification and after going public in the late 90s and then throughout the 2000s here. And real excited about the progress we're making across the company is really positioning it as a supplier of choice for innovative test and process technology solutions. What we're really trying to do is shift this company to some diversified markets with strong secular tailwinds. That doesn't mean we're lessening our focus on semi. Semi is still an important market for us. It is about half of our sales, and we have diversified within semi, going from just primarily back-end test to expanding into front-end semi or on the silicon carbide, gallium nitride, crystal growth area markets, as well as epitaxy applications there. Through our focus on new markets, targeted markets, as well as adjacent spaces and acquisitions, we've got a really attractive served markets that we're approaching a little over $2 billion available to us, so we've got plenty of room to grow. One of the areas I've been focused on is really getting the right organization in place and changing this organization's cultural approach, culture here, from more of a conservative, say, private type company to a performance-driven, results-oriented company out there. And really pleased with the progress we're making and along the transformation, which we'll share with you. The company had a strong foundation for growth when I joined. Again, I mentioned semi is the biggest market for the company. In fact, it was over 2/3 of the business when I started. But we do sell into a number of other attractive in markets in automotive, EV, defense, aero, life science, and securities. Got a blue chip customer base that we have long-standing relationships with. And we are a global company, primarily manufacturing in North America, but have expanded through acquisitions in Europe as well. The core to our transformation is really a 5-point growth strategy that's shown here. And nothing revolutionary, but really things that inTEST was not doing well and can really move the needle for the company. And that's driving growth on global and market expansion, expanding our customer base, identifying new markets that we could go into, and again, getting deeper wallet share within existing accounts. So aggressively expanding our front end go-to-market has been one of our key focuses and has really paid off for us here. Another strategy is innovation and differentiation, near and dear to me as a physicist as my undergraduate. I really enjoy the technology side of things and know the importance of having a robust new product development funnel. And it's something we've been driving across the businesses and really seeing some nice success there as well. Service and support is critical for customer satisfaction, and one that really allows us to keep a customer for life. So it's an area we've been putting more focus on and will continue to do so in the years ahead. And then, as I mentioned, talent and culture is critical to having the right people on the bus and in the right seats on the bus out there, and having a culture that really wants to deliver results here. So really pleased with the progress we've made there. And finally, the last strategy is growth through strategic acquisitions and partnerships to complement our organic growth initiatives that we're driving across the existing businesses. And we've made some great strides there. Most recent acquisition was one we completed in March, a company called Alfamation, headquartered in Milan, Italy. A great strategic fit for us, really expands our electronic test capabilities in a target market of automotive EV, and brings some smaller consumer electronics opportunities as well. The company strategically fits nicely into our expanding our functional test capabilities and bringing a large tier one customer base that we can leverage with our broader solutions out there in the marketplace. So when we think about the combination of inTEST and Alfamation, it really does touch on all 5 points of our strategy, providing global expansion, giving us a stronger footprint in Europe, adding additional test capabilities, automation capabilities around our solutions, expanding our know-how there. Deepens our position in a target market of auto EV, consumer electronics. The engineering know-how and expertise, it really complements us as well. We are a engineered to order type of company, engineered solutions business, and these guys bring some excellent know-how capabilities to our portfolio. And at 25 million, they do bring an impact to our overall growth strategies here, being that we're on pace to try to drive this business to 200 million. So a good sizable backlog coming in. I touched on our serviceable addressable market, just above 2 billion out there. So you can see our subsegments across the 3 technology divisions that we've established in the company there. So plenty of room to grow in our businesses, both organically and with our M&A approach activity as well. And touching on our diversification strategy here, you can see back in 2021, 2/3 of the business was really serving semi. Through organic growth in new markets, new products, as well as M&A, we've now shifted to about a 50-50 mix between semi, non-semi, and we will continue to drive further diversification to lessen our exposure on semi cycles there as part of our strategy. And again, I want to reemphasize, we're not lessening our focus on semi, we're just growing our other markets faster than semi. In fact, through the nearly 4 years I've been with the company, semi has grown double digits for our business, and but we with our other areas growing faster, we're driving that diversification. Quick look into each of our 3 technology divisions. Electronic test, this is where our heritage of the company resides, serving back-end semi test. This is through products with our manipulators, moving test heads in and out of operations, as well as docking solutions and interface solutions. We've added to our portfolio integrated circuit board testing capabilities, as well as battery test systems and solutions to capture more EV batteries, as well as broader batteries used in a wide variety of applications. And then most recently, the Alfamation acquisition expands this division with its automotive testing solutions, primarily dashboard, electronics, onboard computing systems, lighting, et cetera, within vehicles. Shifting to the environmental technologies division, this is where our thermal solutions resides today. We do a lot of state-of-the-art thermal test systems, whether test chambers where you can tightly control the temperature range and acceleration and cooling down to mimic various environments out there. We also have a portfolio of process chillers to be able to tightly to control temperature during various process applications. And then we acquired a product line to expand more into our life sciences with biomedical storage, biobanking, vaccine transportation and storage, et cetera. And then last but not least is our process technologies division. This is really centered around two technologies today, one being induction heating, which is used in a wide variety of markets. Anywhere there's a flame or gas furnace or welding, brazing, you name it, we can do it with induction heating in a much cleaner, greener application. And then we also have image solutions, video solutions with a company we acquired back in 21 that broadens our process tech solutions, be able to capture video where components are throughout, as well as embedded solutions that are used in targeted industries like life sciences and surgical robotics, et cetera. M&A, I mentioned this, but M&A is a core strategy for us and something we will continue to drive, and not only identifying targets, but successfully getting through due diligence and ensuring we've got the right company that should be part of our portfolio, and then in the integration phase. And really pleased with the progress we've made there. Building up our technology divisions here, started with just 3 companies, and today we're 6. And we will continue to scale these businesses both organically and inorganically over the years to come. So with that, let me turn it over to Duncan to walk through the financials.
Thanks, Nick. And in the interest of time, I'll try to move through this relatively quickly. If we look at orders and backlog, as Nick has indicated, although we've been diversifying away from semi, we do still have over 50% of the business tied to semi. Q1 orders down 26% year over year, with the bulk of that decline coming from the semi part of our business, in particular our front-end semiconductor business. On a sequential basis, down sort of 17%. We did see our back-end semi improve a little bit, which helped offset, as I mentioned, that front-end semi decline. From a backlog perspective, our backlog, with the addition of Alfamation, which added over 22 million of backlog, our backlog was sitting at $55 million at the end of Q1, with 45% of that shipping beyond Q2 of 2024. On the revenue side, those orders translating into revenues, a little bit of a smoother profile than we see on orders. Orders can be a little bit lumpier, but we do see that sort of semi-softness feeding through into revenues. 29.8 million there in Q1 revenue. That includes 1.4 million from Alfamation, which closed in the middle of March. So we did see a few weeks of contribution from the new acquisition, which helped drive a good piece of that sequential increase. We move on to gross profits and gross margin. Again, the revenue profile generally translating into that gross profit and margin percentage. So, Q4 and Q1 a little bit softer there. The margin in Q1 at 43.8%. A lot of that drop there. There was about 100 basis point impact because of the 2 to 3 week impact of Alfamation and the timing of some of the costs versus revenues there. That did have a bit of a dilutive impact just purely because of the timing. And we'd expect Alfamation to be delivering margins kind of similar to what we see across the rest of our businesses, which have been consistently in the in the mid 40s. 2021 was a little bit higher there. We did some acquisitions in the back end of 2021, Acculogic, Videology, some of these businesses, which were a little bit lower margin. Our margins have been very consistent since then in the mid 40s. Operating expenses a little bit higher in kind of Q4 and Q1, really driven by corporate development expenses, due diligence related costs, for the most part. We also pick up the 2 to 3 weeks of activity in Q1 for Alfamation. So just under $500,000 of incremental operating expenses in Q1 tied to that stub period for Alfamation. Also, as a public company and a growing public company, our professional fees have been creeping up a little bit. We fell into scope for SOX in 2023, so we did see additional reporting and compliance related spending tied to that. EPS, so we talked a little bit about revenue, margins, operating expenses. In terms of that translating into EPS, that's slightly softer revenue profile there, kind of Q1. Our GAAP EPS of 5 cents for Q1 with an adjusted EPS of 10 cents. If we're looking at the top left chart there, your adjusted EBITDA in Q1 coming in at $1.8 million on net earnings of $700,000. Again, a little bit softer than we'd seen in kind of Q4 and Q1 of the prior year, given the slight softness we've seen in the revenue profile. Moving on to talk about the balance sheet and our capital structure. The business has been generating cash consistently over the last 6 to 7 quarters, and we saw the same thing in Q1, free cash flow of $1.8 million. We did assume some debt with the acquisition of Alfamation, and our total debt at the end of Q1 was around $20 million, with $27 million of cash, so a net cash position of just over $7 million. We do have a borrowing facility with our banking partner, which includes a $30 million delayed draw term loan that we can use for future acquisitions. And we did extend the maturity of that out to the maturity of that facility, recently out to sort of 2031. In terms of capital allocation priorities, we are looking to drive M&A and continue to drive M&A. So, that is really where we'd like to kind of focus our cash. Obviously, managing debt, share repurchase, things like that, to the extent it makes sense to put money towards those items, then we would think about that. But we really are focused on growth primarily. Outlook for 2024, just these are the numbers that we pushed out on the 6th of May when we did our earnings call. And then I will hand it back over to Nick to wrap up here.
Yeah, I'll wrap it up here and open it up for Q&A. So executing the plan, we laid out this transformation, driving the business growth organically and inorganically, broadening our solutions. As Duncan touched on, seeing some tougher headwinds with our semi markets that we're serving there. Obviously semi-cyclical and our exposure being roughly 50% of the business there. But we are managing those headwinds well. And we are part of it driving that diversification and our exposure in other more stable and attractive markets out there. And the teams are very disciplined and thinking long-term strategically and driving actions to deliver the results. So very pleased with what we've been able to accomplish. So with that, let's open it up for Q&A for the next 10 minutes here.
Thanks, Nick. So I wanted to start by asking a question that we got from the audience, and that is, when do you expect the organic book-to-bill trend to turn positive? The audience member gives the example that in 2018, you had roughly 50% gross margins. and then more recently trending into the mid 40s, uh, even though there was incremental scale. So could you explain that, and then also touch on what your goals are for gross margin and in EBITDA margin?
Sure. So yeah, from a book-to-bill perspective, there's some dynamic which many companies kind of seen going on in 2022 with the supply chain challenges. We saw companies placing large blanket orders in order to secure supply and get their slot in production out there. That drove our backlog up to record levels of 40 million, and which then the next subsequent quarters, as we delivered the shipments, the orders were already placed out there. So the book to bill being a little bit less than one. And now in second half of last year, in the beginning of this year, with our second half of last year, back end semi slower, and the front end semi slowing in the first quarter of this year. So that's driving again a bit of a drag on book to bill. But these markets we're expecting in the coming quarters here a bit of a return, a rebound in those spaces there. So we should certainly see book to bill getting healthier here as the future quarters arrive. And as for the margins, Duncan touched on it a little bit. The 18, we had no acquisitions out there, and the most recent acquisitions that really so much more back end semi, higher margin business, part of our overall company. And then as we diversified with the acquisitions of two businesses in 2021, a product line, and then most recently Alphamation, that has more non-semi industrial tech type technologies, still attractive margins for these segments in the 40s +% range of gross margins, but certainly not in the 50+% that we get in our back end semi space. So that's been what's driving that shift in the overall gross margins out there.
Great. And then the next question is really for you, Nick. You mentioned how you came on board in 2020. Could you give a little explanation as to what attracted you to inTEST?
Sure, absolutely. So, yeah, I've throughout my career, worked with large industrial conglomerates, Emerson, Amatec, ABB, but I've always been focused on companies with great technology. And when I looked at inTEST here, I saw that the company had really fantastic technology serving attractive markets, a really solid balance sheet that I could come in and drive my know-how and expertise around scaling businesses, was something I've been doing throughout my career, to this smaller public company and really make an impact. And so it was a chance for me to be really in the front seat here to deliver the growth and build something special. Or throughout my career, working with large industrials where I'm delivering growth, but really more muted in the background because the companies were so large. So that was really what pulled me over, and really pleased I made the transition, and excited about the team I've been building and pulling Duncan over within basically 6 to 8 months after I joined. He came over to inTEST as well.
Excellent. And then the next question has to do with your different technologies. Could you talk about what differentiates your technologies, and then also touch on what the competitive landscape looks like for each of them?
Sure. So as you've seen throughout the slides, we are a bit of a complex company for the size that we are today, multiple businesses, decentralized, but really centered around technology platforms. But the one consistency across the businesses is that they're all engineered solutions that really solve the technical challenges for our customers. And so what differentiates us is our ability to solve these solutions, our engineering know-how and expertise. And this is something that we got decades of experience across a wide variety of our engineering teams out there that allows us to develop really what we believe are the best solutions on the market. And many of our customers feel exactly the same way as they specify our products versus others in the space. So it's that engineering know-how and expertise that differentiates us. And then from a competitive position, because we're differentiated engineered solutions, we aren't up against 800-pound gorillas in this space that have more standard off-the-shelf type products. It's much smaller mom and pops across each of the businesses. So we compete very, very well in our marketplace there against our competitive foes out there. So we're in a good position.
Great. And then returning to the audience, we have a question about the various, you mentioned various companies that you operate. Are the acquisitions integrated at this point, or to what extent are they?
Yeah, so two of the deals of the companies we've shown there were done in 2021. They were smaller, $2 $10 million size companies. And the integration took longer as these were more mom and pop shops, and we needed to get them the right systems and processes and people and that. But clearly, integrated within our organization now. The most recent one, Alphamation, which was just completed in May, larger company, more mature, has systems, well established in that. It's more about aligning them with being part of a public company and our approach to doing things and that. So early stages of the integration there, but in the next 6 to 9 months, we should have these guys fully integrated and capturing some of the synergies that we see across the businesses.
Great. And then I think we have just a few more minutes left. Could you, maybe as an example and a follow-up to that question, talk a little bit about your most recent acquisition and how you found it? What are the metrics that you use when you're deciding on a target?
Yeah, so really excited about how we got this deal done. It's exactly how we've been trying to drive the business, and it really is. It's a bottoms-up approach for our businesses. So each of the business leaders and their teams and division leaders, have identified targets that they believe would be the right technology to add, the right geographic expansion, or an adjacent market that is attractive for us in our targeted spaces. And it just so happens that our technology leader at Acculogic, a company acquired in 21, knew the owner of Alphamation and said, hey, we should explore this. And so they got it on our list. We reached out to the owner, and he was in his mid-60s, had no succession plan identified on who would take over, and was considering selling the business through a sale process. And we were able to circumvent that. We sold the value of inTEST and Alphamation together and what we can do. The owner staying on board with us for the next 3 years to help us through the integration and capturing the synergies. And the owner became a shareholder as part of the deal, so he's going to benefit as we deliver on our plans. So really pleased with, again, targeted approach to companies, selling the value and getting it across the finish line at really attractive multiples so we can create shareholder value.
Great. And then I know we're running out of time, but I'm going to ask one little follow-up on the financial side of things. You mentioned, or Duncan, you mentioned the company's net cash position. Could you make a comparison to your competitors as far as your financial position? How does that compare to your peers? And then could you also touch on what the free cash flow expectations are for the business going forward?
Yeah, I mean, the business, as I mentioned, I think we're 6 or 7 quarters of positive operating cash flow. It historically has been a business that's generated cash. Obviously, there's ups and downs with business cycles, as you know, as you would expect, but a nice cash generating portfolio of businesses. I don't have complete visibility of all our peers and what they look like from a cash perspective, you know, to be honest, but I believe that we have a strong balance sheet with relatively limited debt, not highly leveraged. We did use debt for the first time in the company's history to finance the Acculogic and Videology deals back in Q4 of 2021. And I think we got kind of nice kind of terms on that. So I think our balance sheet and we had an equity raise last year, which was successful. So I think our balance sheet is well positioned and allows us the financial flexibility to continue to look at M&A as we move forward here.
Excellent. Well, it looks like we are out of time, gentlemen, but thank you so much for being here and for all of the thoughtful responses to the questions.
Well, thank you, Pat. We appreciate your interest and everyone participating in the conference today. Thank you.
Take care.